Hey everyone, welcome back to the Weekend Charts. Charlie Bilello here. As always, we're going to discuss the most important charts and themes that we're seeing today in markets and investing. Last show in September, end of the quarter here. A lot to talk about, so let's dig right in, starting with the housing market and the frozen housing market, as we're calling it today. And it seems to be getting more frozen each and every week. And the reason for that, number one reason being interest rates are moving in the wrong direction. So most people finance the cost of a home. Most people put very little down, borrow most of the cost of a purchase of a home, and most people take out a 30-year mortgage when they're buying a home. And the rate on that 30-year mortgage this week hit 7.3%. That's the highest we've seen since December 2000. So you have a whole generation of younger home buyers never seen rates anywhere close to this high. Obviously, older generations remember back in the 80s and 70s seeing mortgage rates even much higher than this, but this is a shock to a whole new generation of home buyers where 3 and 4% was kind of the normal, and they expected that to continue forever. So here we are, 7.3%. What does this mean in terms of demand, in terms of affordability? Well, it means an absolute collapse. And the pending home sale index here is a good indication of this. These are homes that are in contract, they haven't closed yet. So we should expect existing home sales to fall further in the months to come. But they're at now their lowest level since April 2020. And if you remember, April 2020 was not a very good time. Obviously, in America, we actually had most of the economy being shut down at the time, and very few people, of course, were out looking and buying homes. Now, back then, that quickly reversed course. We had that massive stimulus, and today, the expectation, at least, is we're not going to see a sharp reversal. You're going to see continued weakness for months to come. And what's driving that in terms of the continued lack of demand? Well, it's the fact that home prices have never been more unaffordable than they are today. This is a look at, in the red line here, the US Housing Affordability Index, and it's at a record low, lower than where it was during the last housing bubble. And the crazy thing, with mortgage rates this high, you would have expected home prices started to come down. And we did see that for part of last year. But this year, especially the last few months, we've seen the opposite. We've seen home prices move up again, and the Case-Shiller index actually hit another all-time high. So that's certainly not helping on affordability. You have housing prices at all-time highs. At the same time, you have mortgage rates at their highest levels since 2000. So what's another way to look at this affordability picture? I like to look at it as a percentage of income, because that's the way most people, when they're looking to buy a home, they're saying, well, what percentage of my income is this payment to that home going to represent? And a good rule of thumb historically is you don't want to see it very much above 30%. And a lot of people would say 25% is a better position to be in. But today we're at 43.8% in terms of what the median family household income, the percentage of that income that would be needed to buy the median home. So we've never seen it that high before. Even during the last housing bubble, it peaked at 42%. So just at extreme levels. So very few people are going to be buying the home that they want to buy if they're spending that much of their income. And if you went to a financial planner, they would probably tell you that's just too high. It's not going to leave any room for error. If you lost your job or any number of things happen, you're going to be in a difficult position. Never mind the fact that you're not going to have probably anything left over for other expenditures. You're not going to be able to go on vacations or do other things. And that's not a position a lot of people want to be in, of course. So how are the people that are buying homes today, especially younger people with lower incomes, how are they affording this bigger down payment, because prices are at new all-time highs? And how are they affording things? Well, one way would be help from family. And this was an interesting article from Redfin saying 40% of younger home buyers are actually receiving help from family, money from family to make that down payment. Now, of course, that doesn't change the reality of the situation, where ultimately home prices have to be affordable based on income. So yes, in the short term, you can have these stop gaps, let's say help from family or people with high cash balances can come in and buy and say, I don't care about the mortgage rate. But ultimately, in the long run, we've always seen home prices kind of track incomes. And in the past few years, we've seen them diverge, where home prices have exceeded the growth rate in incomes by a wide margin. So the question is, how is that gap going to be closed? And there could be three different ways. Number one would be easiest way would be for housing prices to come down. Number two would be for mortgage rates to come down, and number three would be simply incomes to go up. And that's not going to happen in a short period of time, but continue to go up. They have been going up, but catch up to home prices that way. And obviously, that would be a longer, drawn out process. I think obviously the best way, it's going to be painful for some people, but the best way to make houses more affordable is for home prices to erase some of that crazy mania gains that we saw in 2020 and 2021. And so we'll see what happens. It's almost impossible to predict this because we don't know what's going to change that supply demand picture. I certainly didn't expect home prices to be hitting all-time highs with mortgage rates at 7.3%. So anything can happen. It shows you in markets, but we need more supply is the number one thing holding this market back. There's still obviously people who want to buy homes, but they're not able to. They're unaffordable simply given the current mortgage rates and given where home prices are. So what's driving the situation in terms of mortgage rates will be the bond market. And we just saw something in the bond market that really we haven't seen before, at least in modern history, is a 7-year period now where bonds are actually negative. So over the last 7 years, if you look at the total US bond market index, the biggest ETF out there is this BND ETF from Vanguard. Tells you what the total US bond market's doing, actually has a negative return over the last 7 years. So kind of crazy, kind of remarkable, because people look at bonds as the safe part of their portfolio. They might not expect it to go up a lot, but they certainly don't expect it to go down. And even if it does go down, they expect it to be up shortly thereafter. Now here we are, 7 years with a negative return for bonds. And how did we get there? Well, pretty simple. The yield 7 years ago was around 1.5% on these bond funds, and that's where the 10-year treasury was. And that was a very, very, obviously very low yield. And so your coupon payment wasn't very much. And now you have this rise in interest rates that we've had a tripling in terms of that yield. And that's driving the price of the bond lower, at least in the short run. So ultimately, all of those individual bonds, if they're held to par, will get their money back, but not until they reach maturity. So the way these bond funds work is they're highly sensitive to interest rates in those shorter time periods, even in a 7-year period. So what will the next 7 years bring is the question you're probably asking. Well, it should be something much better than the last 7. And if your expectation back then was for a very low return because yields were pretty low back then, your expectation today should be for a better return. And that's true even if bond yields continue to rise. So in the short run, let's say we go to 5% for the 10-year, you're going to see additional pressure on bond funds for sure. But now you have a much higher coupon to counteract those price declines. So very quickly, you'll start to make your money back. But if we go to 5 or 6%, you're going to still see short-term losses. But over the next 5 to 7 years, you should see a much better return from bonds than we've seen in the last 5 to 7 years. And that's the good news for bond investors who are coming in today. The future looks much better than the past. So what is the Fed going to do? That's the question here. Are they going to continue hiking? Are they going to stay on hold? Or when are they going to start cutting rates? Well, the recent inflation data, I would think, would lead the Fed to say we can pause again. So they paused in September. The next meeting's early November. We got this core PCE reading. This is the Fed has talked about as their preferred measure of inflation. So CPI gets the most attention, but this is something that the Fed looks at very closely, this core PCE, so excluding food and energy. And that moved down to 3.9%, lowest levels in over 2 years. And importantly, you have a Fed funds rate now that's about 1.5% above this core PCE. So in layman's terms, that simply means the Fed is already in restrictive monetary policy territory. So they might be comfortable kind of staying there as long as this core PCE keeps moving down. And the expectation is that it will continue to go down at least for another month or two here. If we look at estimates from the Cleveland Fed and just look at real-time data, not looking at food and energy, but everything else, it seems like the core PCE will decline again in September. So that 1.5% spread that we have between the Fed funds rate and core PCE is the widest we've seen since 2007. And that will continue, the Fed has said, until inflation gets under control. So inflation, even where it is today, moving in the right direction in terms of core PCE, but still much higher than where the Fed wants it to be. They want it to be down closer to 2%. So they're going to be comfortable leaving that rate here for as long as it's necessary. At least that's what they're saying now, as long as the economy is still growing, unemployment is still okay. Their bigger concern is the inflation rate. So the expectations from the market here, 82.7%, so 83% chance that that November meeting, the Fed's going to just leave rates alone at 5.25 to 5.5%. This is going to change a lot in the next month. We're going to have CPI data, we're going to have employment data, we're going to have another PCE reading. All those are going to be drivers, but it seems like a good probability, at least for now, that the Fed's not going to do anything. And I think if the stock market continues to decline here, that'll just be another additional factor for the Fed to say financial conditions are tightening and we should be comfortable holding here, especially since we're already in restrictive territory. So in terms of good news, in terms of inflation expectations for me personally, number one would be looking at the money supply. This was the big driver of inflation that nobody talks about. And we had a huge spike in the money supply in 2020 and 2021. The inflation followed thereafter. And since then, we've seen a big moderation. We've seen now a decline on a year-over-year basis in the money supply for 9 straight months. And we've seen the inflation rate come down. So hopefully the Fed has gotten the message. They're not going to print money again, and that we'll see this money supply remain in check, and that will lead to a stabilization in terms of inflation. So speaking of inflation, I want to talk about healthcare here, unaffordable healthcare. I tweeted this out, got a lot of arguments back and forth from different sides arguing what could be done about this, but clearly something has to change. And what I'm talking about here is the cost of healthcare. And if you're paying anything for your healthcare, not everyone is, but if you're paying for it either through your own work contributions, which is most people, it's provided by their employer, but you're paying something into that, or you're paying for it on your own outside, you have a small business or you're a freelancer, you've probably noticed that the cost of healthcare over the last 20 years has absolutely skyrocketed. And if we look at where we were in the year 2000, $6,000 a year for a family premium. Today we're at 22,000. It's just astronomical in terms of that increase, 249% since 2000. That's a 5.8% per increase every year. 5.8% every year is more than double what inflation has done over this period of time. So it's not simply, well, everything's going up and healthcare is going up the same amount. No, it's going up way more than everything else. And who's benefiting from these increases? Well, you could probably guess health insurance companies love this. They're making windfall profits. United Health Group, largest U.S. insurer, up over 4,000% since 2000 versus 340% gain for the S&P 500. So far outpacing the broad market here. And is this benefiting consumers? I would argue no. I would argue something needs to change. Number one would be more transparency into the system. When you go into a doctor's office or hospital, oftentimes you have no idea what that procedure is going to cost, that visit's going to cost you. You only find that out, let's say, a month or two later. You get this thing in the mail called an explanation of benefits. And it's this wildly complicated paperwork that isn't really detailing you how they come up with the numbers. And the hospital or doctor's office is billing the insurance company for some amount, and the insurance company is allowing another amount, and then you have your own deductible on top of it. And oftentimes it's so complicated that the average person just can't simply figure it out. And that detachment from what the cost of it versus the end consumer of that product is definitely leading to excess, to waste, to just a lack of free market forces bringing this down. And if we look at what the U.S. spends versus other countries, many people have talked about this. It's multiples in terms of a percentage of our GDP, percentage of national income. So certainly not a good thing that we're spending this much if we're not getting the value for it. So I could probably dedicate a whole show to it. So I won't take up any more time talking about it. But clearly, this is an issue everyone should be talking about, and we should try to find simple ways to move in a better direction. I think oftentimes a lot of people say, well, we need to just overhaul everything. We need to change everything. And yes, in a perfect world, perhaps we would do that, but just maybe start with some simple steps and see that that will have a positive output, positive benefit for everyone, and then build upon that instead of just saying let's overhaul the whole thing, tear it down, and start to begin with, because it doesn't seem like there would be much of an appetite for that, and it's just so difficult to get something like that done. So let's talk about King Dollar here, and the dollar has been on a tear. It's probably surprising because we've been talking about national debt, we've been talking about deficit going up, and you would think the dollar would be weakening, but remember, dollar is just a reflection of the U.S. currency versus other currencies, and against other major currencies like the euro and the yen, the dollar has been appreciating. So as bad as you may think the dollar has been in terms of losing its value because of inflation or other things, other currencies have been even worse relative to the dollar. In the last 10 years, we've seen the dollar actually appreciate 43% on a total return basis. This is the dollar ETF UUP. And so I pulled every currency that I could find that wasn't pegged to the dollar and looked at what they did over the last 10 years, and I couldn't find a single currency that appreciated against the dollar. Every single one going down, and some of them down almost completely. If you look at Venezuelan Bolivar, very just a tragic situation going on there. Total almost devaluation of their currency in the last decade, and just a horrible situation there. But we have Argentine peso down 98%, Russian ruble 67%, real 55%. But even things like British pound losing a quarter of its value against the dollar, the euro down 22%. So as much concern as there's been about the dollar, and perhaps rightfully so in many cases, it's still remarkable that it's been the best performer over the last 10 years in terms of global currencies. Now, what impact does this have on your investment portfolio? Well, if you have exposure to overseas stocks, this could either be a tailwind or a headwind. In the last 10 years, it's been a pretty major headwind. So look at European stocks. You're going to have an additional 22% loss if you don't hedge that currency risk out of your portfolio. But there's cycles to everything. If the next 10 years the euro appreciates 20%, you're going to benefit from that over time, having that overseas exposure. And there's no really way to predict what the dollar is going to do in the future relative to these countries. But we know historically, if you look at the dollar index, you see just these big swings up and down, and they can go on for long periods of time. And we're still in the midst, surprising, I think, to a lot of people, of a period of dollar strengthening. And I think two of the major reasons for that is, one, U.S. interest rate policy has been tighter than, let's say, Europe and Japan, in terms of being more restrictive and quicker to be tighter in terms of that monetary policy. And number two would be U.S. growth rate expectations. Economic growth would be higher than those areas as well. So there's still money coming into the U.S. in terms of investment. So this is a really important concept, knowing what you own and why you own it. And Peter Lynch, famous investor, always used to talk about this, but I think about it all the time in terms of somewhat complicated instruments that people have in their portfolio, and they really don't know what it is or why it's there. And I think Treasury inflation protected securities would be one of the primary examples of this. We had this period of high inflation. A lot of people are buying tips in 2021 to protect against that. And now you see where it is today. It's actually lost 8%, even though we've had the highest inflation in the US since the early 1980s. And why is this happening? Well, tips are not the same as buying a Series I bond. Series I bond, some of you may be familiar with. You're getting a fixed interest rate component, and you have a variable component that's tied to, it's just a formula based on CPI. So if CPI goes up 6%, you're going to get that return for that 6-month period. And that changes every 6 months in terms of that variable rate. Now, Treasury inflation protected securities, you're benefiting if break-even inflation rates go up, if inflation expectations go up, you're benefiting from that. But there's a interest sensitivity built into these securities where if interest rates rise, your value of your tip bond is going to go down in the short run, no different than what we talked about in terms of the total market bond fund. So if we're looking at a treasury security, 10-year treasury security, and interest rates go up, well, the value of that's going to go down until you get to maturity, where it'll start to go back to par. But these securities, obviously, a lot of people didn't realize, have that sensitivity to interest rates. And unfortunately, when inflation is high, interest rates tend to be going up or be high as well. And that's counteracted the gains in these securities. And the problem with not knowing what you own and why you own it is you tend to do things that are harmful to your overall portfolio's returns, and things like chasing on the upside and then getting out of the security. So like today would be a good example. When tips have gone down at this point, probably people are selling it. They're like, I don't know what I own. I'm just going to get out of it. And so what we've seen from these tips historically over the last 10 years is time and time again, the return that investors are getting on these tips funds is lower than the actual return of the fund. And that's due to just bad timing and again and again. So if you're going to have something in your portfolio, make sure you know what it is that you own, how it's going to do in different market environments, and why you own it, what that purpose is within your portfolio. And if you can't do that, probably shouldn't be in your portfolio to begin with. So let's talk about quickly equity market indices. We touched on this last week, but I think this is a crazy kind of stat here, showing you the differential between the top 50 stocks in the S&P 500, up 23.5%, and then you look at the equal weight, just up 1% this year, and small caps down 1% this year. So just huge spread in terms of performance this year. This is really opposite of what we saw in 2022, but over a decade long trend where we're seeing large cap outperformance. And is this the culmination of this? Is this the top of this? Who knows? But when you hear that the index is still up 13% on the year this year, just know that the average stock isn't really participating in this. And I talked about last week, perhaps the reason for that, and it could be that smaller companies are just going to be harder hit in terms of interest rates. And if we do go into a recession from the Fed tightening, from higher interest rates, obviously small cap companies tend to have more debt. They tend to have less cash. And so perhaps they're going to be more susceptible in that type of environment. And perhaps that's what the market is pricing in. But we'll see what happens going forward. It's just pretty extreme here to see this kind of differential between small caps and, let's say, the top 50 names in an index. You don't typically see that wide of a margin. So I want to talk about the freedom premium, and this is an interesting one here. The difference between U.S. and China in terms of stock market performance, that I would argue is at least in part due to that premium that investors are placing on freedom. And we'll talk about transparency and other stuff as well. But this is the NASDAQ 100 ETF since December 2009 versus the China Tech ETF, which came out at that time. 832% gain for the NASDAQ 100, 62% for the China Tech ETF. Last 10 years, S&P 500's more than tripled. China large caps down 12%. And at the same time, we hear over and over again that the China economy is growing extremely rapidly, well over 5%, over in the last 10 years, probably 7% if you look at an average annual growth rate in terms of real GDP. And I would ask, well, how is that possible that it's growing at such a rapid pace while their stocks are not participating in that? You're not seeing earnings go up at any at that level, and you actually see the performance of the stocks down over that period of time. And I think it's possible in part because there's no transparency in terms of the actual data here. Nobody knows what the actual growth rate is, but it's hard to just trust and believe what any of the statistics that are coming out of China today. And if you look at what China is doing in recent years, it warrants more and more questioning. So we talked about this a lot last year in terms of what they were doing in terms of interfering with the companies that exist in China and taking more and more control. But this should be as alarming as well. Things like this, where they're blocking people from leaving the country, like people at U.S. firms. They're working there. They're doing consulting, or this is like a risk mitigation firm, Kroll. There was countless examples of this where they're, for whatever reason, and they're not often giving a reason, they're not letting these employees out of the country. And this is a line from this Wall Street Journal article I thought was really relevant here. There's a desire to more tightly control the narrative about China's governance and development and limit the information collected by foreign companies such as auditors, management consultants, and law firms that could influence how the outside world views China. So they don't want any negative press. They don't want people in there, perhaps these consulting companies, collecting data that would perhaps counteract this idea that everything is going great in China and the growth rate is really this high. And just look at the Chinese companies and the profits simply aren't there. It's not the same shareholder protections that we have in the US. So even the numbers that they are reporting, if you believe them, you're not seeing that same level of profitability whatsoever. So what I call the freedom premium, and this is actually flipped from where we were back in 2007 when there was an absolutely mania in Chinese stocks, where Chinese stocks were trading at a huge valuation premium to the US. It's hard to believe now that ever went on, but today that's totally flipped, where the US stock market's trading at a much higher valuation in terms of the CAPE ratio than China. And I would say that some of that is justified. How much is this too wide? I have no idea. But I don't think there's any question that this freedom premium, as I call it, should exist until you can have confidence that the data that you're getting is accurate, and confidence that the company that you're investing in isn't going to be interfered or taken over by the government, or limited in terms of what they can do, or broken up, or the officials there, if they get too powerful, they're going to disappear. Until you have confidence that that isn't going to happen, there should be some type of valuation premium for the US versus China. Now, we can't predict the future, so if things get better there, perhaps this valuation premium will close, and perhaps the U.S. There's too much optimism and valuations will come down. But it's hard to argue, at least the way things stand today, that this isn't rational and somewhat justified to have a premium. The question is, how much, how wide should it be? I want to end with something positive. That's interest rates that investors are getting on things like CDs, savings accounts, going up. And there was a report that JP Morgan is now offering a 6% CD. So you can get a 6-month CD at 6%. But there was just one little stipulation, just a minor thing. You have to take $5 million or more from outside of JP Morgan and deposit it at JP Morgan. So just a minor detail, but still the fact that they're offering 6% CDs when these big banks, if you look at their regular savings rate from JP Morgan's rate, it's close to zero. They often, if you look at Citigroup, Bank of America, I've talked about this, they're often giving almost nothing on their savings account. So interesting to see them try to lure in these wealthy depositors with this 6% CD. How good is a 6% CD compared to where other banks are? It's not as great as it sounds, because interest rates have gone up so much. I looked, and you or I can get a 6-month CD at 5.5%, and you can just go out and buy a treasury bond for the same amount. So a treasury bond yields 5.5% today, and you don't have to move $5 million to get it. Anybody can get that. So these are the highest yields that we have on cash. Look, at year end here, you'd have to go all the way back to 2000 to see yields that high at the end of a year. So we still have a quarter to go, but cash yields, if you're a U.S. investor, and it hasn't been this good since 2000. So it's the opposite of the mortgage market, where mortgage rates at their highest level since 2000, not very good if you're in the market for buying a home. But if you have cash, and that's for an emergency or any number of reasons, you're waiting to buy a house, at least you're getting now an interest rate that's above the rate of inflation, highest rate since 2000. And if you want to lock that up for a longer period of time, again, these are the highest rates we've seen in a long time as well. So 30-year moving all the way up to 4.7%. It wasn't that long ago. In 2020, we actually saw the 30-year at one point go below 1% during the year, ended the year at 1.7%. So just completely different environment for bond investors today than what we saw just 2 years ago. And that's a good thing, because the future for bond investors, or the future for at least the short-term future for cash, is much better than it's been in a long, long time. So we'll end it right there. Thanks everyone for joining me. As always, if you like the content, subscribe to the channel, and have a great weekend. And we'll see you next time on the Week in Charts. Thanks.